Welcome back, everyone. This is part 3 of our series on financial statements, continuing from where we left off in part 2. So far, we've covered key aspects of financial reporting, including the income statement and the balance sheet, statement of financial position. Now it's time to move forward and explore the final piece of the puzzle. In this video, we'll take a detailed look at the elements of the statement of financial position, also known as the balance sheet. We'll break down each component step by step, helping you understand. Let's start by looking at non-current assets, also known as fixed assets. These are assets that a business expects to provide economic benefits over a long-term period, typically more than 1 year. Non-current assets are categorized into two main types. Tangible assets. These are physical assets that can be seen and touched. Examples include property, plants and equipment, PPE, land, buildings, machinery, vehicles, intangible assets. These are non-physical assets that still hold significant economic value. Examples include patents, trademarks, goodwill, copyrights. These assets play a crucial role in the long-term success of a business, as they contribute to operations, revenue generation, and competitive advantage. Next, we'll move on to another key element of the balance sheet, current assets. Now, let's move on to current assets. These are assets that a business expects to convert into cash, sell, or use up within 1 year or during its normal operating cycle. Common examples of current assets include cash and cash equivalents, the most liquid assets, including cash on hand and short-term investments. Accounts receivable, money owed to the business by customers for goods or services sold on credit. Inventory, goods and raw materials held for sale or production. Prepaid expenses, payments made in advance for expenses like rent, insurance, or subscriptions. Current assets are essential for covering short-term liabilities and maintaining smooth business operations. Managing them effectively ensures liquidity and financial stability. Now that we've covered non-current assets and current assets, let's see how they come together to form total assets. The formula is simple. Non-current assets plus current assets equals total assets. This means a company's total assets include both long-term assets, non-current assets that provide value over multiple years, short-term assets, current assets that are expected to be converted into cash within a year. Total assets represent everything a business owns and controls that has economic value. This figure is crucial in financial analysis as it helps investors and stakeholders assess the company's overall financial strength. Now it's time for an activity. Let's test your understanding of asset classification. Below, you'll see a list of different assets. Your task is to classify each one into one of the following categories. Non-current tangible assets, physical assets that provide long-term benefits, like buildings, machinery. Non-current intangible assets, non-physical assets with economic value, like patents, trademarks. Current assets, short-term assets expected to be converted into cash within a year, like inventory, cash. Now it's your turn. Take a screenshot of this slide or pause the video and try to classify each asset into the correct category. Great job on the activity! In the next video, we will go over the correct answers to ensure you've classified the assets correctly. We'll also move forward and dive into the next key component of the statement of financial position, liabilities. You'll learn about current liabilities, short-term obligations due within a year, non-current liabilities, long-term financial obligations of a business. Stay tuned for the next session, where we'll break it all down step by step.